Hey, everybody. Welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon. And today we've got Vessi on the podcast. She lives in Los Angeles and she's been investing in real estate since 2017, but spent a lot of her career actually as a commercial lender. So we dig in a lot to the current lending environment, what's going on with interest rates and what it looks like to analyze deals and deal teams from a lender's perspective. So a lot of education on this podcast about the other side of the desk when we're trying to get debt and loans for these larger multifamily deals. So let's welcome Vessi to the pod.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, Vessi, welcome to the podcast. Happy to have you on.
Thank you so much, Justin. I really appreciate it and glad to be here today.
Yeah, awesome. Well, let's kind of jump right in, I guess. Give me kind of a quick, and the audience, a quick overview of kind of you and your background and where you're located, and then we'll kind of unpeel some stuff.
Absolutely. Yes. I'm based in Los Angeles, California. Started my real estate journey back in 2017 after I picked up several clues along the way, namely the stock market collapse of 0809, my own employer going through a couple of restructures. And at that point of time, I realized I can't control the markets. I don't control corporate restructures. What could I control to preserve my retirement? And that's really what prompted me to start looking into real estate. Like most people started in the residential space, buying that first out-of-state home, which eventually turned into a second, third, fourth investment. And at that point of time, I decided to scale that up as I really saw that opportunity to build that additional income stream through real estate. So at that point, transition into multifamily investing, so buying apartment buildings. And that's where I'm looking to continue to grow and prosper. I also invest passively on the side. And again, the goal was to build that additional income stream in an effort to diversify away from the W-2 income.
Got it. So you said you started your journey in 2017, is that right?
Correct. Mm-hmm.
And so I guess what kind of, other than kind of the stock market, how did you kind of realize real estate was kind of the path that you wanted to go down? Were you in that world W-2 wise? Like, was that part of your kind of just day-to-day operations, or how did you kind of get exposure to that, in the beginning?
Great question. So some of it is from my background. I actually grew up in Bulgaria behind the Iron Curtain. And at the time, there wasn't really a developed stock market. So when people talked about investments, they really talked about hard assets, primarily real estate, not necessarily income generating, but something they could buy, appreciate over a long period of time and pass on from generation to generation. So I guess you could argue that in that moment of crisis, right, you resort back to your old habits or old knowledge. And that's when that seed germinated. But beyond that, with my W-2 job as a commercial lender, I had the privilege of working with a number of investors, primarily in the multifamily space, as well as some commercial retail, which really gave me good visibility into that operating model. Again, mostly from a lender perspective. But I could say that's real. These are people who stacked up assets over time and built that income stream. So it was those two events combined that you could say triggered my thoughts or channeled my thoughts in that direction.
Yeah, and I would imagine the lending space was very different in 2017 to kind of what it is today, right? Like, I mean, it's gone through these evolutions, and obviously now we're recording this in early August 2023. We're in a very high interest rate market. So, like, how did the capital markets or the lending markets kind of differ or similar back then? I can't remember what interest rates would have been back in 2017, but like, how was it kind of the same or different?
Yeah, I mean, definitely a lot has happened since then, and the lending standards have tightened in the current environment. I would say at that time it was still relatively easy to obtain commercial loans. We didn't have the super high interest rates that we're dealing with today, that unfortunately are causing some capital constraints within the lender community as well. Really working with a large lender makes a big difference as well, because they may not be subject to the same concentration caps in terms of industries or types of exposures. Okay. But on the flip side, they have higher compliance requirements. So the process is a little bit more hierarchical and more, structured, you could say. So there are always pros and cons, but definitely then compared to now, I think the lending landscape was a bit more open. And again, there are reasons why it is what it is today due to a number of conditions.
Yeah. So let's go back to 2017, and you were living in, I presume you were still in LA or in California. And, a lot of people that I talk to that live in California don't invest in California. Obviously, there's some, taxes and just kind of, real estate stuff that kind of prohibits, a lot of investors that live in California actually investing there. So let's talk through that kind of first deal, because that's kind of always an interesting kind of mindset shift, right? Because you probably were, historically investing in your 401k or the stock market as kind of like the main investment options out there, which is, what a lot of us are taught, right? We're not taught about real estate investing or passive income or things like that. So how did you kind of find your first deal? Like, talk us through that kind of that evolution and that process, and how did you pick the state you picked? And let's walk through it.
Absolutely. Yeah, that's the first deal is always the scariest. For me, I knew two things. One, I wanted to have that additional cash flow income stream to start building. And secondly, I wanted to be in a business-friendly, landlord-friendly state. So unfortunately, that automatically eliminated investing in my backyard. Not that you cannot be successful, you can be. But to be cash flowing, you need to put a pretty substantial amount down when you purchase a property, and prices are already elevated. So I knew my dollars could go farther and longer if I go out of state. From that standpoint, I started attending a lot of local meetups, webinars, and such, just to educate myself on the topic. Yes, I already had the background as a commercial lender, but really wanted to better understand how you make that happen as an operator or investor. Yeah. Through those meetups, I connected with a gentleman, and one day I picked up the phone and asked him, "Hey, do you know someone who sells properties?" And sure enough, he did. And that particular market happened to be Memphis, Tennessee, which I already had some familiarity with because I had traveled there on a couple of occasions. And frankly, at that point for me, it was just making a decision and taking action. I didn't really want to get bogged down on, well, which market should I choose, which state, which city. I did my preliminary research, not only about the overall market, but also about the sub-market. And what I found was sufficient to make me comfortable with proceeding. And at that point, it was just a matter of taking action and moving forward.
Got it. And how did you, I guess, locate the deals? I mean, obviously, you said you visited Memphis, but presumably you don't have a deep market or network, in that area. So did you just kind of randomly pick up the phone and call an agent, or how did you kind of get plugged in to start seeing deals?
It was through that contact from the local meetup who already had an infrastructure built in there. And that was incredibly helpful because through that, over a period of time, I was able to build deeper relationship with my now existing property manager, local agent that I still lean on if I want to purchase more properties. But the initial contact came through that particular gentleman who was already established in the area. And then as to other markets, as I started expanding into multifamily, so Florida is one of the markets I focus on from that perspective. I already had some presence there through my single family investing and some contacts. But in multifamily, really how I build those relationships is through LoopNet, which a lot of people argue is the place where deals go to die. But I think it's actually the place where you go to find brokers, you underwrite the deals, and maybe they work, maybe they don't, but then you connect with them, provide feedback. Eventually you get on their lists. Eventually you start getting deals. So it's a very gradual process. But that's how I approached it when it comes to the multifamily business.
Yeah, I know. I think that's super fascinating. I want to dig into the LoopNet and the building relationships because it's different on multifamily than single family in certain respects. So before we jump into that, I want to take a quick sponsor break. So we'll be right back.
Whether you're in a job you love or hate, building a financial foundation is important. This foundation can support you by providing passive income, stability in an uncertain economy, or the launching pad for you to start your own business. Great Venture Capital helps busy professionals invest in commercial real estate to build passive income streams, grow wealth, and take advantage of tax benefits. If you'd like to learn more, check us out at greatventurecapital.com or send an email to justin@greatventurecapital.com.
All right, we are back on the Work Hard, Invest Harder podcast with Vessi, and we kind of started your journey and learning about kind of your single family investing kind of process and how you kind of got started investing out of state and found Memphis through that meetup connection. And you kind of started down the conversation of multifamily. So I want to kind of understand kind of the pivot, right? Because a lot of times I talk to people and it's a natural progression where people start in single family because maybe they're not prepared or don't think they're prepared to go up market into a multifamily deal. But was that your thought process? Was let me start with single family. Let me get some, at least kind of flex my investing muscle in the beginning, right? Start to work out and then start to go up market and go bigger. And then, is that kind of how you thought about it?
That was exactly my approach. So it was very gradual, very incremental. You could argue maybe I took the slow route, a slow and steady route. But it really helped me build a comfort level, first of all, investing out of state. And secondly, being able to asset manage the portfolio, because once you go out of state or out of your backyard, you're really relying on third-party property managers. So really figuring out that process and building the systems to vet property managers who you ultimately rely on once you across the borders. But yeah, it was, I still like single family, but when I did the math in my head, it became apparent that I have to buy hundreds of homes in order to scale to a certain level. And so there's definitely the economies of scale and scope with multifamily. Of course, to scale, you also need to partner with others. Well, you don't have to, but in most cases you do. And so that aspect was also appealing to me of not working by myself all the time, but with a team of trusted individuals.
Yeah. So let's talk about that first multifamily deal. And I guess before we do, how many single family deals had you done to that point before you were like, okay, I'm prepared and ready to go up to the next kind of level?
Well, initially my plan was I need to get the 10. Everybody talks about get your first 10 properties, but I actually stopped after property number 4.
Okay.
Because another aspect that I'm not sure if many people realize is a lot of times people think, I'll get the first 10 homes to build my quote unquote resume before I can transition into multifamily. But when commercial lenders evaluate sponsors and operators, they don't necessarily take that into consideration. You really want to see that you've done multifamily property. So for me at that point was, let's not delay, let's just make the transition now. And that's how I got started.
Yeah, I guess before we jump into your multifamily space, I think that'd be an interesting kind of exercise or process. So how do you, let's say I'm looking at a 100-unit apartment complex, $10 million for easy math, for using you as an example, like you can't just go to the bank, a commercial lending bank and say, hey, I want to buy this property, even if you have enough for the down payment, right? Enough that 20, 25%, whatever it is, depending on the leverage, because like you said, you didn't have the track record. So maybe talk about how a commercial lender evaluates the sponsor, meaning the person or people that found the deal and that are going to be kind of part of that general partnership team? Like, how does that work from your side of the desk?
Definitely. So it first starts with the people, because I'd like to say people pay back loans, not necessarily properties. Of course, we like to have the property as collateral, but it really starts with the people, their track record, their character. And that's why lenders would typically like to see at least that you've had operated at least a few properties of similar size, similar scope, that you have familiarity with the market, that you have boots on the ground for that market. And then last but not least, that you have the net worth and liquidity when you're sponsoring a loan, whether that's recourse or non-recourse. Commercial lenders like to see that as well. So oftentimes when you're starting, you may not have the experience, you may not have the net worth and liquidity, but what you can do is find a deal or bring capital or add value in some other way to a team who already has those resources and partner up and collaborate together to bring it through the finish line.
Yeah, that's exactly the thought process that I went through when I was kind of transitioning from, our duplex that we bought first, and then we moved into the syndication space. Was I started looking at deals and I was like, well, what the heck am I going to do if I find one? I don't know anybody in this commercial real estate space. So even if I find this like creme de la creme of a deal, like it doesn't matter because I don't have the people behind me with the experience, with the net worth, with the track record, all that stuff. So it would have been worthless. So I joined a mentorship group and a coaching group, which kind of had all of that ecosystem built in, similar to what you probably did in the sense that you had that meetups that you had already kind of built some connections. So yeah, it's something that people maybe don't think about, especially from a passive investor standpoint of, thinking anybody can just go buy these things. Now you have to have this experience to qualify for these loans. So
absolutely,
that's super fascinating. Obviously I've gone through it from a co-GP side, but talking to somebody like yourself that's been on the other side, kind of evaluating the team. That's a different story. So yeah, let's talk about that first multifamily deal. And how did you find it? Why did you pick Florida? What part of Florida is it in? Like maybe let's talk through that process.
Yeah, so the first JV deal that I did, it was a JV, so 11 units, relatively small. And my second deal followed within a week, and that was a larger syndication. But I selected Florida, as I mentioned, because I already had some presence there. Initially, I was solely focused on Orlando, but there wasn't sufficient deal flow coming in just from this one market, which led me to expand into to look into Tampa and Jacksonville because they met my market criteria in terms of population growth, job diversity, and so forth. So I started underwriting deals, again, initially going to LoopNet. One broker connection led to another, responding consistently. At that time, the market was quite different. I think this year, deal flow has dropped down quite substantially.
Yeah.
A year or two ago, there were a lot of deals, but also competition was higher. And so after underwriting nearly 200 deals, and of those only 5 penciled in for a letter of intent or LOI, and of those 5 LOIs, only 1 worked. And I don't even think we were the highest bidder. But in that scenario, we were able to establish credibility and give the broker and the seller the confidence that we can close. And so a lot goes back to the point you made earlier. While I was underwriting deals, looking for deals, I was also looking for my partners as well as capital partners, talking to various lenders, insurance brokers, property managers. So by the time that deal came along, I already had the infrastructure lined up to take it down, because once your letter of intent is accepted, you really don't have any time. It's 60, maybe 90 days to close. And it's at that point, it's too late to be looking for partners and capital and so forth.
Yeah, you got to be kind of building that team as you're underwriting deals, because once you get that first letter of intent accepted, it's like, okay, you got to have that team built versus you may not need to have all the capital raised because you do have a little bit of time, but you definitely need to have that core core team built. So, so it sounds like that first deal was a smaller multi, 11 units that you kind of JV'd. So you kind of had a small core group of people that kind of brought in all the capital and took it down. At what point did you I think you said a week later, you shifted into the syndication world, which is, a fast turnaround in and of itself. So how did that second deal, that syndication, come about?
Yeah, so it's, I guess, the law of the first deal. So when I first started, I really decided to focus on two things. One is focus on the market, so I'm not spread too thin. And second, focus on a skill set that not only helps me take down deals, but also adds value to others. And for me, based on my prior experience and background, that was underwriting. So the mastermind I was part of, I made it very clear during meetups and events that this is the value I can bring to a team. Over time, people started reaching out to me either for help to underwrite deals or being the second set of eyes. And so how that syndication came along, it was one of the partners that I had been working with for some time approached me for help again to be that second set of eyes. And I declined a lot of deals for better or worse, but that deal actually worked. The numbers were really strong. And at that point of time, I was offered to join the team, even though it wasn't in one of the core markets I was focusing on, because that particular deal was in Georgia. I liked the operators, the market was a good one, and then the deal itself worked. So all boxes were checked except that it wasn't in Florida. So I decided to move forward. And a lot of it was, I guess, timing. It wasn't planned like that. But again, because I was doing in parallel everything, just marketing, building connections, that opportunity came along shortly after we got the JV under contract.
Yeah, I imagine that your secret sauce or superpower in these deals is definitely the underwriting piece, just given your career and professional background. That's probably a very useful tool, because obviously you can use an Excel document to underwrite these deals, but you're going to look at it also from the lending side, right? So you're going to have that extra layer of criticality around, okay, well, is this loan actually something that we think we can get? Because again, it's an Excel doc, so you can make everything look perfect on an Excel spreadsheet. It's just a matter of, is it actually reality and all of that. So, so at this point, I guess flash forward to kind of where we are now in 2023. What does your portfolio look like from an active and passive side? Because I'm just curious, because it sounds like you're still open to both single family and multifamily. You're not kind of just shunning single family. You're kind of you're open to either side.
Absolutely. Yes. I like the single family because it's helped me build a base or foundation. With the multifamily, really what I'm looking for is not only scale, but ability to help others. Just like I wasn't aware of the power of real estate investing, I really want to help bring awareness among others. And so they know that is another tool they can use to build additional income streams, create tax efficiencies, and overall build long-term wealth. So as far as my portfolio, I'm primarily, again, focused on growing the multifamily side. I also invest passively as a way to introduce diversification within my own real estate portfolio, since I entirely focus on the, call it, residential space, whether that's single family or multifamily. So non-multifamily assets like ATMs would be one example, self-storage, those would be a couple others. Again, that's just purely for diversification purposes. But over time, what that has helped me do or allowed me to do is build those various income streams that are now sufficient to replace my basic living expenses and get me one step closer to financial independence.
Yeah, no, that's awesome. And I've actually started to kind of once you start getting into this real estate game from an investing standpoint, you talk to people that are, to your point, and diversified into a number of different investments, right? And so things that I never even thought about, debt funds and all these other things that you can kind of get access to. It's interesting. You start to kind of like, okay, well that could help me to generate more cash flow, whereas maybe multifamily, like we're seeing right now, is generating less cash flow, just because if you're on a variable rate loan, your interest rate went up, and even if you have a rate cap, it's still kind of gone up. So maybe the cash flow is not as great as it should be or could be. But there's still probably appreciation there, right? So you're still kind of, practicing the appreciation game. So no, I think it's super interesting. And do you also help other people passively invest? Like, do you bring them into deals that either you're, that you found, or that you're kind of being a general partner on to kind of help them, get exposure to this asset class?
Absolutely. Yes. That's really the value that I bring to the passive investors. Its ability to vet the operators as well as vet the deal and bring them on as passive investors so they can enjoy those same benefits without having to do that additional work of vetting the sponsor's market deal or even doing the day-to-day management. Because there are people who like their W-2 jobs, they like to stay there. They're not necessarily looking to do this actively, but that doesn't preclude them from participating and benefiting from investing in real estate.
Yeah, that's exactly why I started this podcast, because I grew up in a small town, didn't have any access to or exposure to real estate investing. So I didn't really get into the game until 2018 when I read a book, right? And so, I want to be able to help kind of shrink that timeline for other people, similar to what you're doing, and saying, you don't have to go through the 4 or 5 years that I went through of learning this business and underwriting hundreds of deals and vetting sponsors. You can kind of just come along with me. I'll bring you opportunities. And if you want to invest alongside me, that's great. Right. And so I think it's a super, admirable thing, kind of what you're doing, kind of bringing that option to people that may have not kind of thought it was either an option for them because maybe they thought it was just for the rich and famous, right? But it is something you can get access to, even if you are just a normal W-2 person working a job you love and you just make enough money that you can passively invest. So I guess, you have a lending lens to your background, obviously. So again, we're in this high interest rate environment. So what are you seeing, kind of in the current environment from a commercial lending perspective? Because to what you said earlier, deal flow is way down. It picked up a little bit in the last quarter. But I think I read a stat that transactions are down 75% year over year. So obviously, the lending space is smaller than it was just because they haven't written as many loans. But what are you seeing from the environment, and are lenders being more strict on the type of sponsors they kind of lend to and deals they lend on? Like, what does that look like kind of holistically now?
Yeah, so two things. As far as the fundamentals, those have not changed because the lender ultimately wants to ensure the property produces sufficient cash flow to service the debt plus some cushion. As we're all aware, cash flow has been a little bit more constrained, not only due to higher interest rate, but also due to overall rise in operating expenses, particularly insurance, labor costs, etc. So naturally, in order for them to debt service and meet that 120, 125 minimum, if the price is not changing, the only other lever to change is the loan amount. As a result, you're seeing lenders reduce the loan to values now anywhere from 55 to 65%. Okay. Part of it is also risk management, and a lot of it depends on what lender you're working with, particularly after some of the debacles that transpired with SVB and First Republic. It is my personal opinion that we are going to see a more regulation introduced into that mid-tier banking segment, something that the big five banks went through back in 08, 09. And subject to higher compliance and capital requirements. I do believe that will flow through to that mid-tier lending space, which in result will lead to higher cost of capital for them, hence higher rates and more compliance requirements, and possibly more abundance around industries that they're concentrated with. So if they were particularly concentrated in real estate, you may see some banks pulling out of that. All that to see that the availability of credit has tightened and will probably remain as such in the near-term horizon. Again, this is just my personal view until the markets settle, because again, lenders are also prudently needing to reserve for losses and make sure they minimize that risk, which is why they're being more cautious on who they lend, people who they have pre-existing long-standing relationships with, people with long-standing track record, which is, again, something you build over time. It's not something that happens overnight.
Got it. And I guess as you think about it, is from your background, has it been mainly kind of long-term fixed rate debt that you've been loaning, or do you also do bridge as variable rate, typically, 2-3 year term? Like what's been the vehicle that you've worked in the most, or has it been kind of a broad?
Yeah, for me, for my personal portfolio, and again, that probably comes from my lender experience, I always like to get fixed rate debt. I don't know personally where rates would be. Yes, you can have maybe an opinion of what will happen in the next 30, 60, 90 days. But when you're getting into mortgages, whether those are 3, 5, 7 or longer years, you don't know nobody knows where rates would be. So as I approach each investment opportunity, I always think through, there is risk that I'm taking, right? There's always risk in investing, but how do I mitigate that risk? And so interest rate risk is one of the risks that I look to mitigate, which is why naturally I lean towards fixed rate debt. Even on one of our deals when we had bridge, that was also fixed because, again, I didn't want to play a guessing game of where rates will be today or tomorrow. But that's just based on my experience coupled with my personal risk tolerance.
Yeah, no, I mean, I think a lot of syndicators out there wish they would have opted for fixed rate debt on deals that they bought over the last 2 years. I know that some deals that I'm in, have paused distributions just because they want to make sure that they've got enough cash coming in to float the variable rate debt that they're in. And I think, what are you hearing from? I know you just mentioned we don't know where rates are going, but from your side of the lending desk, do you feel? It sounds like they're going to raise 1 or 2 more times this year, and then maybe pause. I don't know what you're kind of reading from your side or hearing from kind of that world.
That's consistent with what I'm reading and hearing, and probably one more hike. I think Chairman Powell has been very clear on what his objectives are. Pause for a period of time before they start lowering rates again. When will they start lowering? That's, I think, the $1 million question. I think we're in with this rate environment for a little bit longer. And even when the Fed starts lowering, I'm having a hard time visualizing going back to the 2-3% rates that we were experiencing. So I think this is probably the new normal for a while.
Yeah. And I think, I guess, are you in the market now in the sense, are you a buyer in this market? Are you still underwriting deals? Like, what does that look like for you? Obviously, focusing on fixed rate debt is a kind of flagstaff for you to kind of make sure that that's a risk mitigation process that you go through. But what's your take? Are you still in the market?
Yeah, so ultimately, I'm a net buyer. I don't try to time the market. I think that's incredibly difficult to do. So as long as the numbers make sense in terms of cash flow and returns, then I proceed with the opportunity. Now, given the current market environment, it's been over a year since I've found a deal. We may be closing on a deal soon, so that's one I'm really excited about.
Nice.
So again, I believe in real estate long term. I've seen its effect over a long term period of time. So I remain a net buyer, but not just jumping after any and all deals.
Yeah, I don't know if you would agree, but I think if you can make a deal work in this environment right now, it could be a really good deal, just given that, who knows where the rates are going to go, but odds are in, 2 to 3 years, you're probably going to be able to refinance at a lower rate, right? It probably won't be down to the 2 to 3 like we saw 2-3 years ago, but It will maybe be down in the 5s, right? Or something like that, which, on a big deal could be a big savings from an operations standpoint. So, what kind of markets do you like? I know one of the other levers that's being kind of pulled or kind of unfortunately being pulled is insurance rates are going up in a lot of coastal regions, and Florida in particular is getting hit pretty hard. I know I've got a couple of deals there that, interest rates are unfortunately you can't control them, right? They are what they are. And more insurance providers are pulling out of certain areas. So, I guess, are you still in the Florida market? Do you like that? Or are you kind of like pivoting to other markets, just given that insurance risk?
I still like the Florida market. With that said, because of the rates and insurance factors and sellers not adjusting expectations, it's making for deals very difficult to pencil out. So because of that, I'm looking to partner with operators who already have presence and boots on the ground in other markets that I'm already in. So Savannah, Augusta are the ones in Georgia, and then Memphis, Knoxville, Chattanooga, those would be in Tennessee. These are markets I follow. I try not to spread myself too thin. But to answer your question, long term, I believe the Florida market will do well. And I'm still looking at deals as those are presented to me. But it's been the margins are just so thin that it's making, unless the price is adjusted, it's very difficult to make sense of the deals right now.
Yeah, I've been looking at a few deals, and it feels like a few months ago, there was a massive delta between what sellers wanted. It felt like they still wanted a 2021, 2 and 3 interest rate environment price, even in this market. So nothing was really coming even anywhere close. And I think, in all reality, like people were kind of just unsure of what properties were valued at, right? And so, it feels like they're getting a little closer. I'm looking at a deal now that kind of is within the margin of like, oh, this could be interesting, but still TBD on if it's going to actually work out. But I think it's going to be interesting, especially over the next kind of, call it 6 to 12 months, when a lot of these 2 to 3 year variable rate debt vehicles, bridge loans, kind of come due, and it kind of is you got to figure out either refinancing the debt, selling the property, and all that stuff. And I don't want to kind of transition to a little bit of a negative tone, but from a lending perspective, what happens in the event that you get to the point where, you're operating a deal and, you're on a variable rate debt, and you go back to the lender and you say, hey, I can't make my debt payment next month unless we restructure or do something. Like, what is the lender's kind of obligation to do, if anything? And also, if they say, sorry, you signed a contract, we expect your payment on time and in full. And if not, what happens? Like, what's that look like?
Yeah. I mean, generally it would vary from lender to lender, but that's where the relationship comes in handy, and making sure that you're communicating and fully transparent and not quote unquote surprising the lender. So if you see that coming, the key is to communicate up front. In particular, if there is still equity in the deal, if you have a strong sponsorship team with sufficient liquidity and net worth, the lender is generally not in the business of foreclosing property, right? They make money by making loans and getting paid back on these loans. So it's not in their best interest to foreclose. And that's really not the first option they would explore. But if you start dealing with either with nefarious characters, or when there's lack of transparency, or if the deal is completely under where there's like nothing that can save it, at that point, then foreclosure may be the only route. So a lot of it, again, would depend on the deal and the sponsor and the relationship and track record you've built over time in terms of communication, transparency, and such.
And then if foreclosure does happen, like, is that just kind of all of the investors just kind of lose their money? Like, is that kind of what happens?
I mean, basically, yes, unless there's some profit left. First, the lender will get paid first.
Right.
So depending on how much margin or cushion there is, chances are if they lend a pretty substantial amount, like 80-90%, like some of those bridge loans, there may not be nothing left for the investors. But if there is something left, then that will be paid to the LPs, usually LPs first. And then if there is anything left, the GP last. But practically, yes, they may lose their money unless there is some sort of restructure cut out, or if GPs forgo their share and there is another equity partner that may come in. But all of that requires lender permission. So a lot of these conversations around doing shareholder loans, bringing in additional capital partners, all that needs to happen in collaboration with the lender, because if you do it on your own, you're most likely going to be violating your credit agreement and knowingly or unknowingly in default, which is also not a good situation.
Yeah, no, that's interesting. Like I said, I didn't want to try to, go super negative on this, but, when I've got a lending professional on the other side of the mic, it's we're in these kind of weird times. You hear big syndicators kind of in this kind of critical time period. So I do think, if you could put a positive spin on that, there could be a lot of buying opportunities coming out, because some of these syndicators that maybe overpaid or were undercapitalized on the deals, you'd be able to not necessarily get bargains, but you may be able to pick up some deals that were, if they had enough capital, could be operationally sufficient, right? Or positive, and you just need to kind of make sure you have enough capital to sustain. So, so I think I want to kind of transition here a little bit to, the passive investor, right? Somebody that's listening that, maybe they've had some exposure to real estate, or maybe they know me because they came upon this podcast. But like, what do you think are some good tips for people that are just kind of getting started and, they work hard, they make a lot of money, or make decent money, right? And they, want to take some of that money and put it into a place where, you can get some passive income and some growth appreciation and some tax benefits. So, how do you or what kind of tips would you kind of give somebody that's just kind of getting started?
Yeah. So for those looking to be on the more passive side, I would say the key is to, first of all, determine what your investment goals and criteria are. Are they cash flow, appreciation, tax deferral benefits, and such? Select an asset class. It may be something you're more familiar with, like multifamily, or maybe you're interested in other asset classes like self-storage and so forth. And then find an operator, either through local meetups, conferences, social media. Sign up for their newsletters, their platforms. Pick up the phone, or they may be reaching out to you as well, and start building that relationship. So over time, it gives you an opportunity to get to know them, see what kind of deals they're working on, learn more about their track record. So when they share an investment opportunity with you, you're already clear, A, on your investment criteria, and B, on the fact that you want to engage with that particular sponsor, because it's really the sponsor who's driving that business plan, and really the person you're putting your trust and your hard-earned money in, to multiply that money in, or at a minimum preserve the principal. So building those relationships up front is key. And once you have that, you will start seeing deal flow from those sponsors, and selecting in which investments to participate and which to pass on.
Yeah, no, I think that's super interesting and powerful. I think people, think of passive investments as just like, here's my money, go do with it what you will. And, that's kind of what it is, but you need to kind of do some upfront work to make sure that you feel comfortable, because everybody's risk tolerance are different, right? Some markets are more risky than others, but the returns could be greater. So you've got to your point, define your criteria and your risk profile, so that when you talk to sponsors, you can ask them, what's their track record? Where are they investing? What assets they're investing in? And if they don't fit kind of your ideal or thoughts around risk and kind of the markets, then maybe they're not the right sponsor for you, right? Then you got to find somebody else that's doing something a little bit different. So no, I think that's super helpful. So let's kind of transition here to the end. I've got a 3-pack of questions that I ask every guest. So want to jump right into these. What is one piece of advice that got you started or helped you on your real estate investing journey?
For me, it was the fear, honestly, the fear of regret, fear of not taking action, fear of looking back 20 years from now and thinking I should have started, or I could have diversified sooner. I could have mitigated stock market fluctuations and such. So that was one of the factors that really helped me overcome that uncertainty when I made that first investment. So that was on the more negative side, you could say. On the more positive, it's the why, which is the ability to impact others in a positive way through multifamily investing. And that drives me every day.
Yeah, no, I think a lot of people talk about the why and why you start things or don't start things. And obviously fear is a good motivator, right? You obviously thought about like, okay, well, I don't want to regret this or look back. And, even if you would have had maybe a less positive experience than what you've had, at least you don't have to have the fear of not trying, right? And being like, well, even though I've had a bad experience, at least I tried, right? At least I took the plunge. And, I think you're kind of in the process of thinking about going full time into this. So that's like another thing that's like, okay, well, maybe you wouldn't have thought about that 2 or 3 years ago, but now that you have some success, it's like, okay, well, now I'm ready to put more effort behind it and see where this goes. So I think that's super awesome, for sure. What is the favorite real estate or business book that you're into right now?
Oh, that's a great question. The one I'm reading right now is The Creature from Jekyll Island, which talks all about the history of the Federal Reserve System and just presents a different perspective. And then personal development. Really, the two books I tend to mention are Think and Grow Rich, and that's really more about mindset. And something that's helped me stay very organized, especially juggling a full-time job and building a portfolio on the side, is The One Thing by Gary Keller, and really staying focused on the one thing I need to accomplish today to be productive.
I've read that book. I actually I just started they've got one-on-one coaching. So I just actually got some business coaching from them. So definitely like The One Thing, and definitely it's helped me so far. We're kind of in early days on that process, but if you go full time, it may be worth the investment to lean into their coaching, because it is it's really, really good so far. So highly recommend it.
Great.
All right, last question here. So if you hit your financial freedom number, meaning you can live an amazing life just off of the passive income from your investments, what would you do?
Well, I'll definitely spend more time with my family, travel more, and just enjoy life more, as well as have more time to contribute to my causes. Right now, I'm participating in a more passive manner, you could say, by making financial contributions. But animals and planting trees is what I'm passionate about. So hope to be able to contribute not only financially, but also through activities.
Yeah.
Have more time.
That's great. No, I think that's an awesome causes for sure. So Vessi, if people want to reach out to you, learn more about what you're up to, learn about the deals that you're doing, all that fun stuff, what's the best way to find them or find you?
The easiest way to connect with me is through my site, dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. My contact information is there, a link to my personal calendar, a ton of free educational resources, including a complimentary copy of my digital book, The Busy Professional's Quick Guide to Investing in Multifamily, which is designed to educate and empower investors.
Awesome. No, I think that's great. So we'll have all that stuff in the show notes. So Vessi, it's been awesome to connect and learn about you and your journey. And we'll see you soon.
Absolutely. The pleasure was mine, Justin. Thank you.
Thank you.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast, your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.